Meet Ryan. Ryan has been trading for 2 years, which in Wall Street time is basically the same as being a toddler who just discovered fire. His portfolio is up 13% so far this year. He recently made a big win on a crypto meme coin, and naturally, his confidence is now at an all-time high. Ryan's hobbies include rewatching The Wolf of Wall Street, telling girls at the bar about the future of emerging biotech startups, and using Zen. It's safe to say Ryan believes he has what it takes to become a full-time trader. So, Ryan does what any reasonable person would do. He calls his broker, exaggerates his net worth, and gets approved for options trading. Fast forward 3 months, and Ryan is now fully leveraged into out-of-the-money Tesla call options. His strategy? Buy high and sell higher. His risk management? Pure hope. His wife's concern? Why is $13,000 suddenly missing from our savings account? Fast forward another 3 months, and the Federal Reserve decides to raise interest rates. Ryan's portfolio is now down 67%, and his wife's newest hobby is Googling how to divorce a man who calls himself a market wizard. Which brings us to today's question. Why do the dumbest investors win? The answer starts with something called the Dunning-Kruger Effect, basically Darwinism for financial markets. It explains why inexperienced traders think they're Warren Buffett, why smart investors constantly doubt themselves, and why Ryan believes market manipulation is the reason his options expired worthless. Since 2020, you could have invested in almost any stock and made money.
And if you happen to sit on the left side of the Dunning-Kruger curve, like Ryan, you probably even outperformed the S&P. Traditional investors believe investing is about fundamentals and fair valuations, but the traders who have outperformed in recent years are buying companies trading at 650 times earnings, chasing trends that make less sense than pineapple on pizza, and promoting their favorite stocks to anyone who will listen. In fact, I'm pretty sure Warren Buffett once said, "Why buy Apple when you could just buy Fartcoin?" And if you zoom out even further, the reason becomes even clearer. We've been living through one of the greatest bull markets in history. Over the last 17 years, the market has returned roughly 715%. The S&P 500 has basically been on a non-stop party since 2009. So during the past 17 years, almost anything you invested in likely generated a positive return. Because of that, strategies built around high beta and irrational risk-taking have often outperformed and produced alpha. Of course, like every great party, eventually it has to end. The real question is, when? And more importantly, how do you prepare for it? Well, there are two options. The first option is to sit on cash, like Warren Buffett has been doing. But that's boring, and you're probably not here to earn the risk-free rate, which brings us to option number 2. Keep going all in while the market is rising, and then blame someone else when everything eventually crashes. You can blame Jerome Powell, you can blame Donald Trump, or you can blame market makers, because clearly accepting losses personally isn't how investing works. And that brings us back to the main question of today's video. Why do the dumbest investors win? The answer is simple. Retail investors love volatile, high-beta stocks. So let's get slightly more technical for a moment. What exactly is beta, and why does it matter? Beta measures how much a stock moves compared to the overall market. Here's a simple example. Let's say Amazon has a beta of 1.33. That basically means Amazon is about 33% more volatile than the broader market. So if the market rises 2%, Amazon would be expected to rise about 2.66%. And if the market falls 2%, Amazon would likely drop around 2.66%. So why does this matter? Because when the market is going up, a high beta portfolio, which is basically the typical retail investor portfolio, tends to outperform the market. And suddenly, Ryan is trying to book a table at Nobu to celebrate his genius. But when the market starts falling, high beta portfolios feel gravity much faster. Now, Ryan is checking if Payway is hiring. In a bull market, Ryan's high beta portfolio makes him look like the next George Soros. In a bear market, that same portfolio turns him into the next viral post on Wall Street bets. So the next time your friend brags about turning a meme coin into a 10-bagger, just remember, everyone looks like a genius in a bull market.